everybody, my name is Florian. I'm a junior trading mentor at London Academy of Trading. I'm very excited to let you know that we're working very hard in the background on something new. We understand how difficult it can be for aspiring traders at the beginning of their career to build a strategy and a plan and get involved in the financial markets. And apart from the interaction that we have with the tutors on the floor and online, we are planning to bring in accomplished traders and accomplished market analysts that can share their experience, their problems that they had while being at the same stage as you are at the moment. Please feel free to follow us on social media for further updates. Good morning, everybody. This is Florian from London Academy of Trading. I'm a junior trading mentor in London Academy of Trading. Obviously, it's the 25th of September 2023, and I'm more than honored to have Arno as our guest, market analyst, giving us insights about trading, about the journey of a trader, and just insight in the markets. Welcome, Arno. Welcome. Would you mind just a bit of introduction about yourself for our students to get to know you better? I definitely know you. We've been talking on messages for quite some time, and you've definitely helped me throughout my career. And yeah, would you mind just giving us a bit of introduction about yourself?
Absolutely. Thank you so much, first of all, for having me. Really appreciate it. Look, my introduction is fairly short. I've been involved in markets for pretty much a decade now. Even though I'm a professional market analyst now, I didn't really follow the traditional path that many do by first studying finance, then getting into an investment bank, and then going into an analyst role. I basically made a drastic career shift into the markets about 5 years ago. I joined a induction course at that time that was teaching market fundamentals and macroeconomics. And after the induction, I was basically asked to join the team as a junior analyst. 2 years after that, asked me to step into the role as a senior analyst, and that's basically the role that I'm still in today.
Nice, that's quite a journey. I'm sure it took a bit of work to get to the experience you have at the moment, but nonetheless, well done. Arno, can I ask you, I think I'll ask you the very first question. Why trading? Why not something else? Why, I don't know, I sometimes ask the students, why trading? Why do you like trading? What makes you come to trading? And why the market? Why the financial markets and not something else?
Well, I always laugh when I tell people this story, because I actually joined trading for all the wrong reasons. A friend of mine, this is now probably 11 years ago, a friend of mine dragged me to one of those horrible trading seminars held by a company which I won't name now, but one of those probably trading scammers out there, basically promising you the world, promising you're going to get rich quick. And they promised me that I would get a Lambo, and unfortunately I never got that Lamborghini, as you can imagine. But what that taught me, that really just awakened a massive passion for financial markets, because even though I saw through the nonsense pretty quickly, I knew that there were traders and firms out there that actually did know what they were talking about, that actually has made a career out of it. And I was infatuated with it. I remember myself spending, and I used to work in a different industry, obviously, before I decided to take on the role as a market analyst. And I worked long hours. I would probably work, let's say 12, 13 hours. Afterwards, I remember myself spending another 3, 4, 5, 6 hours every night, going through videos, going through materials. So it was just a passion for me. So when I got the opportunity to, look at something to maybe do that more full time, I just went for it with everything. And very glad that I did, because now I'm able to do what I like. But yeah, my start was actually not one that I would be very proud of. I thought, man, this is great, get rich quick. But yeah, obviously it didn't work out that way. But at least it set me on the right path, that wrong encounter.
Yeah, it's quite interesting, Arno, because we talk a lot of the students that come here, and obviously everybody has a different perspective about trading. But looking back at when I started trading, I'm sure you know my journey as well. It's like I joined because I wanted to, just be responsible for my own actions, But then I soon found out that the market is not as the market environment is not as an easy environment as I hope to. And then obviously it comes the hurdles that the whole journey puts ahead of you. You know, maybe what you think you know is not what you actually should be knowing, or like you said earlier on, you know, all the channels out there, YouTube channels, all the media channels that maybe sell you the wrong product to a certain degree. But having said that, you know, what have you found that was the main pitfalls? You know, what in your opinion are the main pitfalls for a new trader, for somebody that is at the beginning of the journey, an aspiring trader, feels very strongly about this, like everybody else that get involved in the financial markets? You know, what do you think are the main pitfalls for somebody at the beginning of their journey?
I think the very first one, especially for a new trader just starting out, you absolutely have to manage your expectations correctly from the start. You know, don't be like me who thought, hey, you know, this is a get rich quick thing. That is a complete lie. You know, it's not going to happen. Don't expect to take a quick training regime of a few days or weeks and think you will be, you know, the next George Soros or the next Paul Tudor Jones. It won't happen. It's much harder than what people think. And I think one of the biggest issues I have with some people in our industry is that they sell a fake dream that, you know, trading is easy. You know, you can master it in a couple of weeks' time. And I mean, you would know from your experience, that's a lie. It just doesn't happen that way. You think about it this way. Would you trust a surgeon that went for a quick 2-week, you know, seminar to operate on you? No, you would never do
100%
that.
not, 100% not, of course
So
not.
what about a builder that he's never built anything in his life. He quickly went for a 1-week seminar and now you trust him to build a house for you. It just doesn't work that way. So just like any professional, you know, career out there, it takes time and you need to manage those expectations correctly. If you have a dream that you're going to step in and, you know, all the rules that applies to every trader out there doesn't apply to you, it's going to be a very, very bad situation for you. So I think the first thing is manage your expectations. The other thing that, you know, this took me much longer than it should have to sink in, but don't try and catch every move in the markets. You know, when you start out, you're going to be like a hungry lion, you know, that wants to try and run and catch everything that runs past you. That's a trap, right? Don't try and catch every single move that you see. There's no way you can do that. That's a quick way to lose a lot of money. You know, that's something that I always say. You know, I sound like a broken record when I say that, but I really do believe it, is take the right trade at the right time for the right reasons. That's what you need to focus on. It's not possible to try and catch every move. Professional traders, we don't think that way about the markets. There's going to be plenty of moves that you see that looks exciting, it feels exciting, you wish you were part of the action, but if it doesn't fit in line with your process, don't go chasing those small rabbits. Wait for that big antelope, that big zebra that you can catch. Focus on those things. Don't get, you know, sidetracked, I think, by big moves in the markets that you weren't prepared for. The other thing that I would think is, from a pitfall perspective, is don't try and overcomplicate your trading. You know, I think a lot of times when traders get started, they think that adding more indicators, adding more rules, adding more, you know, things to their system or their process will make them more successful. And it's just not true. You know, at the end of the day, if you're going to be looking at too many things at once, you're going to experience what we call that analysis paralysis, where there's 1,000 things in front of you and you don't know which one to focus on, which one is important. So don't fall into the trap to think that the more complicated you make things, that suddenly that's going to mean more profitability. It's actually not true. That's not how it works. The other thing that I would say is a big pitfall, especially as a beginner, assume in the beginning that you are going to be wrong most of the time. You know, as a beginner, I think sometimes you think or you hope that you're going to be the next, you know, like we say, George Soros or whoever. You're probably 100%. Not. Right? As a beginner trader, I know you think that somehow it's going to be different for you and you'll be able to turn, like, you know, pro in 3 weeks' time and you're going to outsmart and outtrade everybody out there. You won't. You know, believe me when I say this, that this industry employs probably the smartest people and brightest people on the planet. I've worked with a few people that are they are insanely smart. You cannot imagine the type of smart people that's involved in this industry, and even they get it wrong constantly, right? So as a beginner trader who has no experience, assume that you're going to be wrong a lot of the times. And the reason why that is important to know is that, you don't focus on your profits as a trader in the beginning. Focus on learning a good process for trading. That's what you need to focus your time on. Focus on the process and not the profits, because when you focus on the profits, you're focusing on, you're assuming that you're going to be right the whole time. Rather assume that you're going to be wrong, and the only thing you need to work on is getting the right process, cement it down so that eventually the profits will start coming by itself. I think those are probably the biggest pitfalls that I can think of for new traders.
Yeah, fair enough. I 100% agree, obviously. But having said that, you just mentioned, the larger market participants out there. I remember one of the videos you had out there at one point, and you said, I can't remember the name of the fund, but they were down like 40% over year to year. And obviously they are employing the smartest people out there, with high intelligence and different way of approaching the markets and so on. And speaking of approaching the markets, I don't know, would you be able to kind of share with us how do you trade? How do you go about finding a trade? Do you look at more a fundamental direction? Do you look at technical direction? Or do you try to combine the two together in trying to, say, okay, I have a trade idea and now I'm looking for an entry in my trade? Because one thing that we try to explain, to our students, including ourselves amongst tutors here, having a trade idea and having a trade are two complete different things. But just from that perspective, would you be able to give us some insight in regards to how you trade personally? Obviously not your trade plan and so on, but just like a general idea.
Yeah, absolutely. I mean, when I started out, I was purely trading technicals. That's many moons ago, and I did okay with that. Not great, just okay. But when I started learning about market fundamentals, that really it opened my eyes to a whole new world, so to speak. I realized that a lot of the information that I had been craving about the markets at that time, it kind of fell into place when I learned about the fundamentals. Now, if you can have all the fundamental skills and knowledge in the world, but if you don't know where to execute a trade, if you don't know where to anchor stops, if you don't know where to get out of the markets, then all of that fundamental knowledge means absolutely nothing to you, right? So I firmly believe that a very good trader needs both. Obviously, your weighting towards which one matters the most will, I think, mainly come down to your personality, your style of trading. I know many traders who have a very high technical weighting, but they do include the fundamentals into their process. Personally, I would call my process a 20-80 where I would say 20% of that would be purely technical and 80% of that would be fundamental. So what I try to do is I try to find a trade that makes sense to me from a macro fundamental perspective, and then I look at the technicals on basically finding areas where I think I can execute on that trade, where to get in, where's the good areas to get in, where to anchor stops, where to get out. But I always start my trade from a fundamental point of view instead of a technical one. But I firmly believe you absolutely need both of them.
Yeah, that's a good comment actually. I mean, looking back at the way I trade, I think statistically speaking, the best trades I've had were when I had a direction in the market from fundamentals, and then I've managed to define my risk through technical analysis. But looking at the other way around, when I had direction in the market from the fundamentals, but I didn't manage to get a proper entry, I just got run over by the train, because not being able to join the flow of the charts and execute in a technically correct method obviously can be detrimental to you. And I think that's a great insight in regards to trading. But coming back to the weight you have in technical versus fundamentals, obviously understanding the macroeconomics, it's a never-ending journey. But what advice would you give to somebody where to start? Because obviously you have all this you have calendars online, and every time you click on a calendar, it's going to tell you what of data is coming at what time and how is that going to impact the market. Where would you start in regards to what's more important? I mean, because you can't learn everything, but there has to be a starting point to a certain degree.
I think, look, macroeconomics it's such a broad topic, and it's very difficult to pick one thing. But I would say that as if somebody's just starting out, what I would tell them is don't fall into the trap thinking that you need to go study economics for 3 years at uni, because what they teach you there is not how things happen in the real world. What you learn at uni in terms of, and I've studied macroeconomics, from a university perspective. After getting a role as an analyst, I've done many additional certificates and diplomas. And what I would tell you is that what you learn there is just theory. It's fancy theory, and you get to be able to, engage in certain economic discussions, but it will help you absolutely zero in terms of the game of trading, right? So what you need for trading is you need practical economics. You don't need theory. The theory won't work for you. In the market, it's a whole different ball game. And what you need to do is you need to learn what the markets will focus on, what drives them the most. So if I had to choose one thing as a beginner that I would absolutely start with, it'll be with learning more about central banks. Learn who they are, what they do, how do their decisions impact various asset classes, so know how a surprise interest rate decision, know how that'll impact interest rate markets, how it will impact bond markets, equities, the FX space, linked commodities. You absolutely need to know that. I think if you start there, that's a good thing. The reason why I say that's a good thing is that when you start learning about central banks and their decisions, you will learn about the macroeconomics anyway, because when you learn about the central bank, you learn about why they care about inflation. You'll learn about how interest rate decisions that they do impacts the relevant currencies. You learn about GDP. You learn about things like quantitative easing and quantitative tightening, geopolitics, sentiment. So I think central banks would probably be the best place to start. I think that'll give you the most bang for your buck, basically, in terms of a new trader, because just, starting out, learning about inflation, where do you even start? It's just to pick a central bank. Maybe the Fed's going to be your best option because that's the best mover, and just start learning about them, who they are, what was their most recent decision, why did they make that decision, what was expected before the decision, how did what they decide to do, how did the actual outcome differ from expectations, and how did the markets react as a result. I think that'll be where I would start if I had to start all over again in terms of macroeconomics.
Yeah, that's an interesting topic you brought up, Arno, because just looking back at the way I started trading, obviously we are all looking at the same data. So if I was to put, a S&P 500 chart up on 1 hour, I'll be seeing the same information as you are seeing, and every other trader on this planet is trying to place a trade. And then I think what my next question leads to is, how would you go about bending the financial market around your personality? Because that is why we all have different trading styles. I mean, you were talking about the weighting between technical and fundamental earlier on. Probably I have a different weighting when it comes to trading. But how would you go about finding your own way in the market, revolving around your own personality? Because obviously, if I was to have a trade plan, or let's say you have a trade plan, and you say when this happens and this happens, I do this and this if I see another X or Y. How would you advise somebody to build a trade plan around their own personalities? Because me copying your trade plan or the other way around, I'm sure it's not something that that could work long term, if I can put it that way. Where do you think the importance of developing a trade around somebody's personality comes in, as opposed to just taking maybe signals off of a channel or a bot or something?
I think it's a difficult one. It's a very, very difficult one, because when you start out, you're basically going to be at the mercy of whoever is training you, right? And to a very large degree, you're basically going to be trying to trade someone else's edge. I wish there was a quick answer, but as you would know as well, I think the best thing that you can give yourself in terms of finding an edge that fits your personality would be giving yourself enough time to develop that. Understand that even though my edge works for me, it's not going to work for most traders out there, right? Because everybody's got a different, everybody thinks about risk differently. They think about opportunity differently. There's a lot of issues involved with that. So I think the biggest thing that you can do, or my best advice for that, would be give yourself time to find something you are comfortable with. It's not going to happen in the first week. It's not going to happen in the first month. Probably not going to happen in the first year, I would say. Give yourself enough time to develop something that works for you. And even though it's tempting to want to just, trade someone else's signals, and, in the beginning, it's definitely going to help you, you absolutely need to find that discipline to develop your own edge in the markets. If you don't do that, then you're never going to be able to adapt to the markets. Because the thing is, something that works for us right now won't be working for us the same way in the next 3 months or the next 6 months. I mean, you've been, looking at the way that we trade. In certain economic environments, there's just certain ways that we trade that won't work in a normal environment, right? There's
100%, yeah.
You have to shift the way that you trade, and those things take time. So I would say just give yourself enough time to develop that. And like we said earlier, manage your expectations with that. It's not going to happen overnight.
Yeah, that's a great piece of advice, to be honest, Arno. I mean, looking back at the way I started and in my journey as an aspiring trader and trying to understand where I fit in the market, I looked at macroeconomics, technicals, smaller time frame, larger time frames, larger trends on, weekly time frames, going back to smaller time frames for lower time frame trends and so on. But I think maybe, and again, if I could have an opinion from you on this as well, that would be much appreciated. I think maybe aspiring traders should spend as much time as possible getting screen time to develop their strategy, and the only way maybe for them to be part of the game is by having a robust risk strategy, because obviously if you're not in the game you can't make it, if that makes sense. I don't know, in regards to risk management, would I be able to get some insight? I mean, do you risk, I'm not asking particulars, how much to risk per trade or something like that, but how would you advise an aspiring trader to go about managing their risk? I know this is a subject that we could talk about for countless hours, but obviously just a quick opinion would be much appreciated.
I think, like we said in the previous one, is your challenge as a beginner is you're not going to have your own edge in the markets yet. You need to develop that. You're going to be trying to learn someone else's edge, and the challenge with that is it's probably not going to fit your personality the way that you would have hoped it to. Sometimes you get lucky and it does, but most times that's not going to be the case. So I think from a risk management perspective, your main goal on a risk management side, while you are on that journey of finding your own edge, is making sure that you risk small enough amounts to just stay in the game and not blow up. Right? That should be your number one goal as a beginner. Don't blow up. Try and trade as small as possible, keeping your leverage as low as possible as a beginner. I know a lot of traders advocate, the basics, risking 1% on every trade and, something similar to that. But even 1% in many cases might even be too much for a beginner trader. Risk less and make sure you stay in the game. The reason why most beginners don't want to do that is because they work it back into a monetary value, right? So they have a $10,000 or $20,000 trading account, and they work, let's just say you have a $20,000 account. They work back that 0.5% or that 0.25% risk, and they're like, wow, but that's just $50 or $100, that's not exciting. So don't go look for those big pop winners. I would say the trap is that you look at the monetary gain or loss and you think, this is just wasting my time. But you need to make sure you give yourself enough time to stay in the game. So, if you're going to be trading for the excitement of it, risking 5 and 10% or whatever on every single trade, it's not if you are going to blow up, it's when you are going to blow up, right? So don't fall into that trap. Don't chase the excitement. Make sure that whatever you're risking is low enough to give yourself that time to develop your edge.
Yeah, that's an interesting insight, Arno. I was talking to one of the students a while back in the past, and we were talking about going live, and and this probably comes back to managing expectations, like you mentioned earlier on. And we were talking about when to go live, and how much to risk per trade, and what the expectations are. I think one of the items that came out through our discussions were, okay, let's say you want to trade, a 50K account. Why not start with and you feel the need to have skin in the game so you can get the psychology behind placing a trade and actually understand, because it's different when you trade a demo account, and then once you go live, a whole different set of emotions take over, and then the fear of missing out comes in, and you're looking at your P&L and say, oh my god, I'm down already, I only entered the trade. And one of the things I said is, maybe instead of going, okay, let's say you don't want to trade demo in the market, but then you do want to go live just to get the experience, maybe go with a smaller size account, and let's say if you want to trade £50,000 account or whatever, it doesn't matter, the amount of money is not important, but maybe trade, I don't know, go for a 5,000k account, for a £5,000 account, and then at the end of the month just multiply the gains or the losses as if it would have been a larger amount, and then see how the emotions take over if you had a down month or if you had a positive month. Because the worst thing that can happen is for you to have a down month and then actually look back and say, well, instead of me making X amount this month, I lost X amount this month. How would that have affected my psychology and so on? Which kind of leads to the next question. Do you think beginner traders go live in the market too quick?
This is such a difficult one to answer because everybody's different, right? Everybody learns at different speeds. Everybody has a different attitude about risk. Everyone deals with their emotions, like you say, differently. So there really isn't a one size fits all when it comes to that. What I would say though, like you said already, is that people tend to take things more seriously when they have skin in the game. It's very difficult for you to take monopoly money seriously. I've seen traders turn $100,000 demo account into $1 million in less than a week, right? And then that same trader opens up just a 5K live account and they blow it up in a day or two. That makes it very, very tricky because live markets and real money are entirely different from the demo markets and monopoly money, right? So when you're trading demo, you're going to get perfect fills every time. You're going to get ultra tight spreads. You're probably not going to see your spread widen going into and out of an event. It's just a perfect environment to make money. The moment when the odds are stacked against you in the live market, when you don't get great fills, when you don't get tight spreads, that makes a massive, massive difference. So I would say take as long as you need personally to move into a live account, but just know that things will be 100% different when you have skin in the game. So I would rather, like you said, advocate for a smaller account, but doing things live than sticking to a demo and basically learning the wrong way. Because that's really what we do with a demo. And I know we need to practice, and by all means practice as much as you want, but just know that if you're going to stay in a demo account, it's just not the way that the markets move. There's so much difference that comes into play, especially on the emotional aspect of it, like you mentioned. So I would advocate that having skin in the game is better than not having skin in the game. But if you're the type of person that just won't be able to deal with it, then maybe trading itself might be something you need to reconsider. If you're going to,
it might be challenging, if
you're going to be trading a 5K account and you lose $100 and it's the end of the world, I mean, maybe trading isn't something that you need to consider. So make sure that you are comfortable with the money that you put in. And, I know this goes without saying, but don't ever risk something that you can't afford to lose. That I think is a really, really, it's something that everybody knows, but it seems like many traders forget that. Just make sure that whatever you do risk, make sure that it's not something that's going to hurt you if you lose it. Because as a beginner, the odds are stacked massively against you that you're probably going to lose a lot of it until you find your edge.
Yeah, 100%. I mean, I remember myself. I was trading. I was trying to trade an RBA decision one morning, and for UK time, I think it was like 5 o'clock in the morning. I woke up, had a bit of coffee, turned on my computer. My charts were ready. The data came in as expected with a surprise against market consensus, and I've tried to execute, and I kept pressing the button to buy, and I couldn't see my orders on the screen, only to realize after looking my account, I got filled in so many times at the incorrect level that it hasn't even appeared on my screen. But obviously, I was getting filled at such a higher price with a small stop in trying to catch a big move and the holy grail of trading and so on, that I got stopped out so many times before even realizing I was on the wrong side of it. And then but I think that's where the difference between understanding how live markets behave when you have a spread, when you have volatility increasing, and getting filled at the wrong price, not the wrong price, but not the price you were expecting as well, because that can be definitely a hurdle in the way when you press the buy button and your stop is in the wrong place, your entry is in the wrong place, and so on. And sometimes maybe you can't experience that on a demo account. But yeah, that's 100%. I've been down that road, but should I have gained the experience I gained while executing live? 100% not. 100% not. Arno, what do you think the final thoughts, let me, if I can put it that way, on the journey of a trader? I mean, starting from, I know this is, again, it's an open-ended question and we can talk about this for hours without even having a cup of coffee, but how do you think a trader should go about, like, from the moment they decide to get involved in the market? Obviously there must be a process they follow. How do you find that process? How do you find the process approach? As in, some traders might show up at their screen and today place a trade based on a certain process, and then tomorrow they trade a different process, as opposed to having one trade plan and stick into it, and then let's say in a month's time you can look back at, I don't know, let's say 100 trades, something hypothetical, and look back and say, well, I've done this for 100 times and I've learned that these tools don't work, or these tools do work, but maybe I'm applying it wrong on the wrong time frame. Where do you think the importance of having the same approach to the market every day comes from, or is that a biased mentality?
I mean, again, as a beginner, the challenge is making sure that the process you follow is one that fits your personality, and that's going to take time. You need to give yourself enough time. It's not going to happen overnight. It's not going to happen in a week or a month, maybe even in the first year. It takes a lot of time. But I think, something that that we advocate a lot is, once you have found, even if it's somebody else's edge, right? Once you have that process, make sure that you give yourself enough time for that process to work its way, to work its way into your own personality. Because what we oftentimes do is we have, when you look at the markets, you take 3 trades, right? And all 3 of them might be losing trades. What a beginner tends to think is that, okay, I've tried this process for 3 trades now, all 3 was losers, so I'm going to assume that this edge doesn't work. But there could be so many things that happen in that environment that could have made that trades losing trades, which might have nothing to do with the process, right? Maybe it's sometimes it could just be where you got in, where you got filled. Maybe you were a few seconds too early or a few seconds too late. So even if it's someone else's edge, just give yourself enough time. I think that's the most important thing. Like we said earlier with risk management as well, make sure that you're risking enough to take it seriously, but make sure you're risking less or low enough amounts to just stay in the game, because you are going to be wrong a lot. You're going to make a ton of mistakes on your way there. Experience is far more valuable than what you realize right now. It takes time to gain it. So yeah, I think final thought is just give yourself enough time.
Thanks, Arno. Thank you very much. I mean, we're getting closer to the end of the interview, but there's a few more things I would just like to run by you. I mean, when I started trading, which was a year and a half ago, a year and 8 months, not that I'm counting, since I started trading, it's like the whole financial markets went upside down to my experience. I mean, we had the Ukraine war, we had Nord Stream 1 problem blowing up, Nord Stream 2 getting shut, we had Bank of Japan intervention, we had all high ECB raised rates after being famously neutral for so long. All banks across the whole globe had experienced high inflation in trying to maintain a decent economic environment. Where do you think we're heading now? Because I mean, we had so many problems, and it's like any other trade that we have. When you have good data coming out and the charts are failing to show that, as in going long, maybe. Where do you think we're heading at the moment in regards to this whole cycle that we are at the moment? I mean, bear market, bull market. Where are we kind of in regards to the whole financial market sentiment? If you would care to maybe just give us a few thoughts on that.
I think something that was difficult over the last, let's just call it 12, 18 months, was that inflation was a global problem, not a individual country problem, right? Inflation was a huge problem globally, and it still is to some degree a big challenge. And what that global inflationary scare created was a massive amount of policy convergence, right? Everybody started to hike rates, apart from the BOJ, of course. But when everybody is doing the exact same thing, it's very difficult to have an edge because there's not a lot of relative dynamics to play with. Where we are now, though, is that we're starting to see a lot more of that relative policy dynamics coming into play. And that I think is really exciting because as most central banks are getting very close to the peak interest rates of this cycle, the focus will now start to turn to that relative growth and that relative inflation dynamics to assess who will be able to keep rates higher for longer, who might have to hike again, and the worst case, who might be the first bank to need to cut rates. So I think watching relative inflation and growth dynamics will be extremely important in the months ahead. I think really, really important in the months ahead. At this stage, whether that means we are in a bear market, bull market, I honestly don't know. When it comes to equities haven't really been responding to the macro fundamentals a lot recently. I think it's been tricky to trade. The best opportunities that I've seen right now, and again, that comes in line with that relative policy dynamics, is in the FX space, right? We've seen a lot of interesting developments with the US right now. There's that US exceptionalism where the data has been so good. Growth data has continued to surprise to the upside. That hasn't been the case in the Euro. That hasn't been in the Eurozone. It hasn't been the case in the UK. So that alone has already set up quite some interesting dynamics. But those things won't stay that way. And I think that's what we need to focus on. Speaking of inflation, though, as you know, one thing that we've been saying since the end of July is that the markets are too complacent about where commodity prices were. A few weeks down the line, markets are starting to get very, very nervous now again because commodity prices are ramping up over the last couple of weeks. That's going to place upside risk to headline inflation in the weeks and the months ahead. Everyone basically assumed that the banks are done hiking rates, that they're going to start, reaching peak terminal rate. And even though that is the case, it might not stay that way. But again, it comes into play with right now. I think if you want the edge that I'm focused on right now and where I think the markets are headed is the focus will be on that relative policy dynamics. Where's the relative growth? Where's the relative inflation? That's going to dictate what the central bank will do. And that can open up a whole bag of opportunities, whether you're trading bonds, FX, equities, probably not so much. But yeah, that's, I think, where the markets are headed now. It's not going to be all about inflation anymore. It's going to be on that relative growth and inflation dynamics.
Yeah, thanks for that, Arno. That's quite interesting, actually. It's quite interesting. And Arnos, you are a man of vast knowledge. As we're heading towards the end of the interview, and I'm going to really put you on the spot here. I'm going to ask you a very, very difficult question. If you was to place a trade for the end of the year, let's say just before Christmas, last day before the markets close, and you were to hold it for 1 year until next Christmas, let's say, what would that be? Now that is going to put you on the spot because hopefully, I hope it's not going to be in a year's time we're going to catch up again. But what trade would you take at the end of the year to hold for 1 year? Long, short? I don't know. I'm going to leave that entirely up to you.
No, knowing what I know now, I'll say long oil. That's long something oil. that I've been trading long, as you know, for a while now. Not in it right now, but if I look at where the policies are headed, especially in places like the US, where if you take a look, somebody was out. Tracy Stuttgart, you guys should follow her on Twitter if you don't do already. She was out with some pretty interesting data looking at where refinery capacity is sitting currently. People in the oil industry, they're not investing enough to try and get refinery capacity up, right? So you can pump as much oil as you want. If you can't refine it at a steady pace, there's always going to be that challenge with regards to supply. And there's a lot of issues and concerns right now about recession or not recession, and whether it's a recession or not. If I take a look at a bigger time frame, right now the supply demand dynamics for me is looking very favorable for oil. So if I had to choose one, knowing what I know now, I would say long oil would be my preferred buy and hold from Christmas to Christmas.
Okay, fair enough, no problem. Yeah, that was great, Arno. Thank you very much for your time. We really appreciate having you giving your insight in regards to trading and the journey of developing as an aspiring trader. And I hope our students will find this interesting, and I do hope we're going to catch up again. And again, thank you very much.